Ladies and gentlemen, while the United States was distracted fighting economic wars on its periphery, obsessing over tariffs in Europe and resource claims in the Arctic, a far more devastating, intimate betrayal was executed quietly in the dark corners of the global banking system. It is a betrayal that cuts to the very heart of the special relationship between the United States and its closest neighbor. On January 15, 2026, forensic analysts monitoring warehouse stock reports of the Shanghai Gold Exchange detected a massive, unprecedented, and statistically anomalous inflow of physical gold into the international board vaults located in the Shenzhen Free Trade Zone. This was not standard commercial flow. The bars were 400-ounce good delivery bars, the standard of Western central banks, being rapidly recast into 1-kilogram bars, the standard of the Chinese market. Tracing the flight logs, insurance manifests, and refining data points to one entity as the source of this metal. It is not a rogue hedge fund. It is not a Swiss bank. It is the government of a neighboring nation. To understand the magnitude of this event, we must step back and look at the history of this nation's gold. For nearly a century, gold mining output, some of the richest on Earth, flowed south to New York or east to London. It was refined by the national mint, stamped with national symbols, and sold into the Western banking system. It was the safe supply. It was the bedrock of the North American collateral pool, but that flow has reversed. The data indicates that this nation is now bypassing New York and London entirely. It is shipping its newly mined gold directly to Shanghai. This is not just a trade deal. This is a custody switch. The nation is effectively moving its sovereign collateral from the custody of the US dollar system, the Federal Reserve, and the LBMA, to the custody of the renminbi system, the Shanghai Gold Exchange. It is the geopolitical equivalent of a bank run initiated by America's polite neighbor to the north. Why would this nation do this? Why would a G7 nation, a NORAD partner, and a NATO ally defect financially to the east? The answer lies in a traumatic policy error from 2016. In 2016, under then central bank leadership, officials famously sold all official gold reserves. They sold the last ounce. They proudly declared that gold was an archaic asset that yielded no interest, and that holding U.S. Treasury bonds and a diversified portfolio of fiat currencies was a smarter way to manage a central bank balance sheet. This nation became the only G7 country with effectively zero gold reserves. They bet the entire national balance sheet on the stability of the U.S. dollar and the permanence of the Bretton Woods rules-based international order. 10 years later, in 2026, that bet has failed catastrophically. Policymakers have watched the U.S. weaponize the dollar against adversaries and even allies. They have watched the purchasing power of their bond portfolio evaporate due to inflation. They have realized that in a world of war and debasement, holding paper promises from a bankrupt neighbor is not safety. It is a suicide pact. They realized they were naked. They had no insurance. They had no neutral asset to settle trade if the dollar system froze. But here's the twist. They couldn't just buy gold and store it in the Bank of England or the Federal Reserve Bank of New York. Why? Because they saw what happened to other nations. They saw assets frozen. They saw repatriation requests delayed. They saw the counterparty risk inherent in Western vaults. So they opted for a new model, the gold road mechanism. China offered a deal that New York could not match: storage, liquidity, and access. By storing gold in the Shanghai International Gold Exchange, the nation gains direct access to the world's largest physical gold market. The Shanghai Exchange is the only exchange where price equals physical delivery. Furthermore, the nation gains the Shanghai premium. Gold in Shanghai consistently trades $20 to $50 higher per ounce than in London due to high demand. By selling and storing there, they earn an arbitrage profit on national wealth. But the most critical aspect is political leverage. This nation is currently being crushed by U.S. protectionism, as we saw with the EV tariffs. By moving its gold to China, officials are signaling to Washington that they have other options. They are building a financial bridge to the BRICS bloc. This is the northern defect. It is a quiet vote of no confidence in the Pax Americana. When a country moves its gold, it is preparing for a change in the regime. This nation is hedging against the collapse of the U.S. dollar standard. This undermines the very foundation of the Western financial alliance. If this country, the nation that is integrated into the U.S. economy more than any other, does not trust New York to hold its wealth, who will? The vaults in Manhattan are losing their gravitational pull. The center of gravity for global collateral has shifted to the Yangtze Delta, and the implications for the U.S. dollar's status as a reserve currency are fatal. The custody switch of existing financial assets is just the tip of the spear. The deeper, more permanent shift is happening in the physical supply chain, the actual dirt and rock being dug out of the northern shield. This nation is a mining superpower. It is the world's fourth largest gold producer, digging up over 220 tons of the yellow metal annually. For generations, this geology was effectively an extension of the United States Strategic Reserve. Mines were owned by national or American companies. The metal flowed seamlessly across the border. In 2023, a statistic showed that roughly 37% of gold exports went to the US and 28% to the UK. It was a closed loop of Western liquidity. But in late 2025 and early 2026, that pattern broke. Export data shows that shipments to London and New York have stagnated or declined, while exports to other destinations, a euphemism for Asia and intermediaries, have surged. The other is China, and the mechanism is direct acquisition. Over the last 5 years, while Western capital markets were obsessed with ESG mandates that defunded mining companies, Chinese state-owned enterprises were shopping. Giants have been aggressively acquiring junior and mid-tier miners. While the government made headlines by blocking Chinese investment in critical minerals like lithium and cesium under national security grounds, they quietly allowed the gold deals to proceed. Gold was not deemed critical in the same way battery metals were. It was seen as just a financial asset. This was a strategic error of massive proportions. By acquiring these mines, China has effectively captured the source code of the supply chain. These Chinese-owned mines are no longer selling their doré bars, partially refined gold, to the national mint or to Swiss refiners. They are shipping the concentrate and unrefined metal directly to refineries in China. Once it enters the Chinese refining system, it vanishes from the Western ledger. It effectively becomes part of China's shadow reserves. But the strategy goes even deeper than ownership. It involves the financial plumbing of the mining sector. The Shanghai Gold Exchange has launched a specific targeted program called the Gold Road Project. This mechanism allows foreign miners struggling to raise cash on venture exchanges to deposit their future production directly into Shanghai certified vaults in exchange for immediate renminbi financing. This is a honeypot. Western banks have stopped lending to miners because of carbon footprint concerns. China stepped in and said, "We will lend you money. We will fund your exploration. We will build your infrastructure. All we ask is that you pledge your physical gold production to our exchange." Miners, starved of capital and desperate to survive, took the deal. The result is that gold mined from the frozen earth is now effectively Chinese collateral before it even comes out of the ground. Beijing doesn't even need to own the equity of the company. They control the flow of the metal through offtake agreements and debt covenants. This flow is draining the liquidity of the LBMA, London Bullion Market Association. The LBMA is the center of the global paper gold trade. It relies on a constant influx of fresh mine supply to settle the massive volume of trades that happen every day. If that fresh supply is diverted to Shanghai, the London market begins to dry up. The float of available gold shrinks. This creates a permanent condition of backwardation in the West, where spot prices are higher than futures because of shortage and a surplus in the East. It breaks the pricing mechanism. The loyal ally has inadvertently become the feedstock for China's dollarization strategy. Every ounce of gold that flows from a mine to a Chinese vault is an ounce of gold that cannot be used to bail out the US dollar when the debt crisis hits. The mining pipeline shift is a structural change. It cannot be reversed overnight. You cannot break these contracts easily. China has secured the physical supply lines of the ultimate money, leaving the West with nothing but printed fiat and empty holes in the ground. The driver of this tectonic shift isn't just the federal government or the mining companies. It is the quiet giants of the national financial system, the pension funds. The National Pension Plan Investment Board, along with a group of large pension funds, represents one of the largest and most sophisticated pools of capital on the planet. Collectively, they manage trillions of dollars. They are the smart money. For decades, their strategy was simple and aligned with the West, the 60-40 portfolio. They bought U.S. equities for growth and U.S. bonds for safety. They were the reliable buyers of Western debt. But in 2025, their strategy shifted aggressively, and the asset allocation reports confirm a radical pivot toward real assets in Asia. While officials publicly announced a pause on direct investments in China due to political optics and regulatory pressure, the flow of funds tells a completely different, much more nuanced story. They are not investing in Chinese tech stocks or real estate developers, which are toxic. They are investing heavily in global infrastructure and commodities that feed the Asian engine. And crucially, they are moving their custodial assets, the safe haven portion of their portfolio. Reports from institutional custodians suggest that pension funds are increasingly using the Shanghai Exchange International Board for their gold exposure rather than the COMEX futures market or London-based ETFs. Why would a pension fund do this? Because of fiduciary duty. The managers of these funds have a legal obligation to maximize returns and minimize risk for retirees. They are not politicians, they're allocators. They see the US dollar being debased by $2 trillion annual deficits. They see the US bond market becoming volatile and politicized. They see the weaponization of the Western financial system, where assets can be frozen if you disagree with US foreign policy. They look at the risks and ask, where's my capital safest? Paradoxically, they have decided that for physical commodities, the safest place is the market with the most liquidity and the strongest demand, China. The distinction here is between allocated and unallocated gold. In the Western banking system, London, New York, much of the gold trading is unallocated. This means you don't own specific bars. You own a claim on the bank's pool of gold. You are an unsecured creditor. If the bank fails, you become a line item in a bankruptcy proceeding. The Shanghai Gold Exchange operates differently. It is built on a foundation of allocated physical storage. When you buy on the Shanghai Exchange, you own the specific bar. It is titled to you. In a global financial crisis, which these pension funds clearly anticipate, they know that paper claims in London will be settled in cash, force majeure. They don't want cash, they want the metal. Shanghai guarantees the metal. This pivot is a massive vote of no confidence in the Western fractional reserve gold system. The pension funds are essentially betting against the stability of the very system that created them. They are seeing the debt spiral in the US and the UK, and they are choosing to exit. They are hedging their exposure to the West by buying the primary asset of the East. This aligns with the broader trend of sovereign diversification we are seeing globally. But the northern defect is the final confirmation that the fracturing of the global financial system is not a theory. It is a completed fact. The world has split. Even the closest allies of the United States, neighbors who share a border, a language, and a culture, are hedging their bets against the US dollar. Moving gold to Shanghai is the ultimate signal that counterparty risk has become the primary concern of sovereign states. They're more afraid of US seizure or debasement than they are of Chinese authoritarianism. That is a staggering realization. So, how do you position yourself in a world where nations trust China more than the Fed? How do you protect your personal wealth when the sovereign giants are running for the exits? You follow the protocol. Protocol Rule 1, audit your custody. This is the most important lesson from this move. If governments and pension boards do not trust New York vaults to hold their gold, neither should you. If you hold gold in a bank safety deposit box in a major Western bank, or if you own unallocated gold in a pool account, you're exposed to the same risks. In a bail-in scenario or a force majeure event, unallocated gold is not yours. It is a liability of the bank. It can be used to pay off the bank's other debts. You must move your assets to non-banking private vaults. Ideally, these vaults should be in neutral jurisdictions that respect property rights and are not deeply integrated into the US-EU banking system. Singapore, Switzerland, specifically outside the banking system, and the Cayman Islands are the gold standards. You need to be outside the banking system's legal reach. You want title, not claims. Protocol Rule 2, follow the miners. The miners that are plugging into the Shanghai ecosystem are the winners of this new order. They have access to capital from Chinese banks and a guaranteed buyer at a premium price, the Shanghai Exchange. Look for mid-tier gold producers with assets but strategic partnerships or offtake agreements with Asian entities. These companies are insulated from the Western credit crunch. Avoid miners that are purely dependent on Western equity markets for funding. As ESG mandates tighten and liquidity dries up in the West, these miners will be starved of capital. The miners selling to the East have the wind at their backs. The miners selling to the West have the wind in their faces. Protocol Rule 3. The real asset rotation. The pension funds are rotating from paper bonds to real gold infrastructure. This is the smart money trade. You must do the same. The traditional 60-40 portfolio, 60% stocks, 40% bonds, is dead. It relies on bonds acting as a hedge against stocks. In an inflationary debt crisis, bonds and stocks fall together. You need to adopt the sovereign portfolio, or what I call the 30-30-10-10 allocation. 30% productive equities, high-quality companies with pricing power, energy, defense, essentials. 30% real assets, physical gold, silver, commodities, productive land. This is your inflation shield. 30% short-term cash, liquidity to buy dips and pay bills without selling assets. 10% asymmetric hedge, a bet on the complete failure of the fiat system. You are preparing for a world where sovereign bonds are no longer the risk-free asset, but the return-free risk. Protocol Rule 4, watch the currency. This geopolitical pivot puts the currency in a highly precarious position. If the United States retaliates against this defect, if they view this move as a betrayal, they could weaponize trade agreements to punish the currency. The currency could crash relative to the USD if tariffs are imposed or capital flows are restricted. However, there is a bull case. If the nation successfully pegs its resource exports, oil, gold, potash, to gold and yuan pricing rather than USD pricing, the currency could evolve into a commodity-backed option. It could detach from the USDI and track commodity prices more closely. This creates extreme volatility. Do not hold significant wealth in this currency unless you live there and spend there. For international investors, treat it as a commodity option, not a safe haven currency. Diversify into USD for liquidity and gold for savings. The northern defect is the quietest, but perhaps the most significant event of 2026. It signals that the US dollar's hegemony over its own continent is fracturing. A nation has moved its collateral to the competitor's camp. The flow of gold has reversed. The West is losing its grip on the physical world. Get your gold out of the system before the gates close. The protocol is active.